I finally sold Oracle in the rated A portfolio. Oracle was a massive win for us, but great portfolios are not built on nostalgia. Since October 9th, I've been warning members of Rated A that a sell could be coming. And last week, at $285 per share, I finally sold the entire position. That was 3% of the portfolio. In this video, I'll be going over a review of why I bought Oracle in the first place, providing some context, and then mentioning the red flags that I simply couldn't ignore. All right, let's get right into it. So, why did I buy Oracle in the first place? The purchase happened in May of 2021, back when Oracle was selling for $77 per share. So let me first just emphasize that this wasn't a quick trade, a momentum trade, or anything like that. I held Oracle for 4 years, more than 4 years in the portfolio. And in that period of time, a lot of things have changed. Now, back in 2021, the thing that everyone was talking about was the cloud. ChatGPT hadn't been invented yet, and nobody was really talking about AI in any space that was mainstream. So, the big growth engine was the cloud, and by far the most dominant player in the space was Amazon with AWS. Microsoft was way behind, but second in terms of market share with Azure, and Google was further back than Microsoft, the third player in the space. And at this point, Google has just reached the market share required to make its Google Cloud profitable. Back then, the narrative was that the cloud business was an excellent business with many years of growth ahead of it. Most of the enterprises in the world were in a transition phase, going from having all of their databases on premises, like in the office basically, on site, and moving those to the cloud, aka to let them be hosted by a third party like Amazon, Google, or Microsoft. So there was just a huge tailwind that was expected on that end. And because it was now so easy to get all your databases, all your backend to be hosted by a third party, a bigger third party that had already made the investments, a whole bunch of digital startups were springing up. Because of those big three, the Amazons, the Microsofts, and the Googles, now entrepreneurs were able to start up companies very quickly and very cost efficiently by renting out the cloud space. Cloud was just seen as an excellent business because of all this growth that was expected, and also because it was a super scalable business. You just have to build the infrastructure once, and then you can host many, many different companies on that. Also, it takes a lot of scale to be able to build all this infrastructure, and the only three players that were in a position to do that were Amazon, Google, and Microsoft. These big tech companies that were just gushing so much cash. So basically, this was the infrastructure of the future, the picks and shovels, if you will, of our increasingly digital world. So that brings us to Oracle. In 2021, Oracle already had a super profitable database business, the legacy business. It had an optionality on the cloud, and it was selling for a relatively undemanding price. Let's double click on each of those. Let's start with the strong database business. Oracle's clients are companies, and those companies organize their data in an Oracle database. That allows the data to communicate from one part of the company to another. For example, finance can communicate with marketing, which can communicate with HR. You could compare it to the central nervous system of a business. Oracle invented the database back in the 1980s and has always been the leading player in this industry. And the same way that it's really difficult to have surgery and operate someone's CNS, the spine, the brain, it's really difficult to do that. It's very dangerous. Well, for a company, it's also very difficult to make any changes to the ERP system, to the databases. Once it's in place, it's most likely going to stay with Oracle for the lifetime of that company. The TLDR version is that Oracle's database business has extremely high switching costs, and it's also very profitable because of that. The next point is that Oracle had a lot of optionality with its cloud business. Originally, Oracle was building its own cloud infrastructure to be able to migrate its own clients that were using Oracle's databases on premises and then switching them over to Oracle's cloud. For Oracle, this makes sense. They don't want to have their clients in an Oracle database, but on someone else's cloud. They want to keep control of the customer. But the point here is that Oracle was the fourth largest cloud provider after the big three. Now, the chart you see here on the screen is from Q3 of 2024, but back in 2021, it looked very similar to this. Yes, Oracle was the underdog, but they were still in the game. Now, the cherry on top of the cake was that the valuation for Oracle was extremely undemanding. People were not pricing in the cloud business at all. For example, Amazon, Microsoft, and Google, the big three, were trading at an expensive multiple, around in the 30 range. And deservedly so, they were excellent businesses. On the other hand, Oracle in 2021 was trading around 18 times free cash flow, almost half. And if you just took a quick glance at the company's financial, maybe 18 times free cash flow seemed like a fair price. After all, the revenues hadn't grown much in the previous decade. But when I looked at the details, I could clearly see that Oracle was a mix of two companies. On the one hand, you had the cloud business that was very profitable, growing at a very fast pace. And on the other hand, you had the legacy business, the on premises databases that was shrinking. So together, the sales were staying flat, but one side was growing, one side was shrinking. Thing is, every year that passes, the shrinking business becomes less important. And eventually, the business that is growing is going to take over in terms of importance and carry the business forward. Looking at Oracle's revenues today, it's clear that that thesis was right. If you're enjoying this video, make sure you subscribe to this channel so you can learn how to invest like a pro and build a portfolio that crushes the S&P 500. At Rated A, we're beating the index by over 10% so far this year, so you don't want to miss out. The story around Oracle has changed a lot in the last 4 or 5 years. Today, Oracle is one of the major companies associated with the build-out of all the AI infrastructure. It used to be called the data centers for cloud. Today, it's for AI, but the story is pretty much the same. Oracle is investing more than ever in order to capitalize on this opportunity to be the infrastructure of the future, the digital world. To be one of the largest, or in Larry Ellison's words, the largest AI player. And with a P/E ratio of 58, the market valuation is reflecting that. So that's the headline of what's happening to Oracle these days. Fundamentally, there have been changes. The first is that the AI build-out is not coming cheap for investors. Oracle used to be a highly profitable, highly stable business. Just look at the margins over time, very stable and very high, and this has dropped in recent years. Oracle used to do a lot of share buybacks. Now the share count is going up. Of course, Oracle is also taking on more debt. And that's because building AI data centers is not cheap. It takes a lot of capital, more capital than Oracle actually generates from running its business. So it's a pretty aggressive strategy. Not necessarily a bad one, but a very aggressive one. If the AI story doesn't pan out, or if companies realize that they're not getting the ROI that they want from AI, then Oracle could find itself in a overextended position. For me, the straw that broke the camel's back was the deal with ChatGPT. This deal that you saw all over the news, $300 billion in a cloud deal. The first thing to note here is that OpenAI is not going to pay all this money to Oracle right away. First of all, they can't. OpenAI currently generates around 50 billion of annual recurring revenue, and it's actually not even profitable at the moment. So in order to actually receive this money, Oracle is going to depend on investors giving money to OpenAI or banks giving money to OpenAI. That's the first thing. The second thing is that even if OpenAI gets the money, Oracle is not going to receive parts of this $300 billion until the middle of the 2030s. this deal, this payment is going to happen in tranches, and the later ones are going to be happening in 2033, 2034. Despite the uncertainty around this deal, despite the fact that Oracle is having to spend before actually receiving the money, the stock has exploded upwards, going up almost 40% in a single day. Investors are acting almost as if Oracle has already received the cash in its bank account. So, our philosophy here at Rated A is to let your winners run. Don't cut the flowers and water the weeds. Don't sell just because of valuation. But this case is pretty unique in the sense that the valuation got so overextended that I see more risk than potential upside with Oracle today. So that's why I ended up selling Oracle and deploying the capital from that sale to a better opportunity. So, what about you? Do you have Oracle in your portfolio? Are you thinking of keeping it or have you sold already? Let me know in the comments below. Also, let me know what I'm forgetting, what I'm missing with the Oracle story, why I'm wrong basically. That's it for this video, and I'll see you in the next one.